You finally have exactly $100 ready to invest, but opening the App Store presents a wall of brokerage options, and the fear of choosing the wrong one keeps that cash sitting safely in your bank account. This diagram shows what is actually happening to that money right now. With inflation running around 3% and a standard savings account paying roughly 0.5%, holding cash results in a silent 2.5% loss in your purchasing power every single year. But before you try to outpace inflation in the stock market, you have to verify whether you carry any high-interest consumer debt. The historical average return of the stock market is roughly 10%. The average interest rate on a typical credit card is 24%. Paying off a balance at that rate guarantees a 24% return on your money with zero market risk. Wealth building does not begin with picking the perfect tech stock. It begins by plugging the high-interest leak in your own wallet before you try to fill the bucket. Your consumer debt is at zero. You have a crisp $100 bill ready to deploy into the market. The choices you face today boil down to a strict trade-off between total automation and complete control. Pick the wrong tax vehicle or a platform with high management fees, and you will leak hundreds of thousands of dollars in taxes and lost compound interest over the course of your career. We are going to build an investing roadmap, a decision tree designed to route your $100 to the exact right strategy based on how much time, capital, and expertise you actually possess. Success in the market does not require wealth. It requires a financial structure optimized for your specific psychological profile. The absolute first check you need to make is with your employer. If they offer a 401k match, that is institutional free money. If your company matches 50% of your contributions, allocating your $100 there yields an instant, risk-free 50% return on day one. The required trade-off for that match is liquidity. Those funds are strictly locked up until you reach age 59 and a half. Otherwise, you trigger severe early withdrawal penalties. If you lack an employer match, or you have already maximized it, your next decision is choosing between a standard taxable brokerage account and a Roth IRA. This line graph projects investing $100 a month for 40 years, yielding a final balance of roughly $637,000. In a standard brokerage account, you will owe roughly 20% in capital gains taxes on that growth. That is $127,000 legally owed to the government. A Roth IRA uses money you have already paid income tax on. The capital grows tax-free, and when you withdraw it in retirement, you owe exactly zero. You keep the entire $637,000. The mathematical hierarchy is rigid. Capture your full employer match first, then maximize a Roth IRA before putting a single dollar into a standard taxable brokerage. Once you select the correct account type, you have to decide who actually manages the assets inside it, an algorithm or you. Robo-advisors like Betterment and Wealthfront offer total automation. You answer a questionnaire about your risk tolerance, and their software builds the portfolio, automatically rebalances it, and executes tax loss harvesting with zero manual input. The cost for this convenience is a perpetual management fee, typically 0.25% of your total assets every year, slightly reducing your long-term compound growth. You can bypass that fee entirely by building a DIY 3-fund portfolio. Purchasing total U.S., international, and bond index ETFs achieves the exact same market diversification and drops your management fees to effectively zero, but you must manually log in and rebalance the allocations yourself. If you are prone to checking your balance daily and panic selling during a market crash, paying 0.25% to a software program to enforce behavioral discipline is a highly rational purchase. For investors who choose the DIY path and prefer to manage their own $100, 3 massive institutions dominate the space. Vanguard operates on a unique structural advantage. The company is owned by its own funds, meaning it is owned by the clients themselves. Their singular objective is keeping expense ratios as low as mathematically possible. Their trade-off is a rigid user experience. Their interface is intentionally bare bones to discourage emotional trading. They refuse to offer cryptocurrency, and fractional shares are almost exclusively restricted to their own ETFs. Fidelity takes the opposite approach, building a high-tech ecosystem and using loss leader products like their zero-fee index funds to aggressively capture market share. They allow you to purchase fractional shares of nearly any asset for a single dollar. They also offer direct integration to manage Bitcoin and Ethereum alongside your traditional retirement accounts. Schwab caters to the analytical trader. Following their integration with TD Ameritrade, they provide elite technical analysis tools, deep market scanning, and complex charting capabilities directly in the platform. They also offer a unique checking account that reimburses global ATM fees, integrating well with a travel-heavy lifestyle, but their fractional share trading is strictly confined to S&P 500 companies. There is no universal winner here. Your choice depends entirely on whether you prioritize extreme cost efficiency, ultimate flexibility, or deep analytical tools. This matrix maps trade-offs to 4 specific investor profiles. First, the total beginner. If charts induce anxiety, open a robo-advisor. Second, the modern DIY techie. For sleek interfaces and crypto, open a Fidelity account. Third, the index purist. For rock-bottom fees, choose Vanguard. Finally, the analytical nomad. For complex charting, open a Schwab account. The subtle differences between these platforms matter far less than the act of choosing one. Analysis paralysis is the primary threat to your net worth. Time is the absolute only variable in this entire compounding equation that you simply cannot optimize, negotiate for, or purchase later. A 25-year-old investing $100 a month ends up with roughly $637,000 at retirement. A 35-year-old executing the exact same strategy ends up with $227,000. Delaying action by 10 years costs over $400,000 in lost compound interest. Exorbitant commissions and transaction fees have been eliminated from the industry. The only remaining barrier to your financial security is your own hesitation. Select your exact investor persona. Open that specific account. Do it right today and set up an automatic monthly transfer for your first $100. The most profitable time to enter the market was 2 decades ago. The second best moment to act is right now.